So I think it's now 4 o'clock. Let us begin while the other friends who are joining are slowly getting into the conference. So first of all, on behalf of ISID, let me welcome everyone. And especially the speaker of today, Andrea Goldstein, and the three eminent panelists, Professor Pami Dua, Rajeshwari Sengupta, and Mr. Joshi from CRISIL, and all of the participants, online and physical, at ISID and ISID-IGIDR, to this policy roundtable on India and the global economic growth. OECD Economic Outlook 2023, which we have jointly organized between ISID and our sister institute, IGIDR. And the background or context for this discussion today is that world economy is passing through a very difficult time, a challenging time in terms of the fact that a number of leading economies, major economies, are facing the threat of recession, or threat of recession is looming large on many of them. China, which is the second largest economy, is slowing down, and inflationary pressures are persisting despite tightening in many countries, many economies. Against that, backdrop, India, or Indian economy, appears to be a kind of bright spot and a beacon of stability, if you like, because the second quarter results have just been released, which showed very healthy, unexpectedly better kind of growth than was expected. And the projections are that for the full year, we may be getting somewhere between 6.5 to 7% growth. And inflation is relatively in control, but then we will listen to the experts. And so in that context, I think what Mr. Andrea Goldstein is going to do is to share with us the perspective or highlights from the OECD's Economic Outlook 2023, which had just been presented, I think, a couple of days ago, a few days ago. Very fresh from the oven, as they say. And the title or subtitle of this is Restarting Growth or Restoring Growth. Restoring growth, which is very apt for the time we are living in. And I'm sure he would share with us some key highlights from that report. And then we have these three eminent panelists who can bring their own perspectives to this discussion. So I would, begin with inviting Andrea to share the highlights from this report and any other, messages he wants to bring to us from Paris. And Andrea, is basically, he has been a part of OECD Secretariat for many years. Currently, he heads the India-Indonesia desk at the Department of Economics in OECD. And he has been an old friend because we worked together on FDI-related issues many years ago. And since then, we have been in touch. And for a very brief period, he was also a colleague at the UNSCAP, although in a different office there in mine. He was based in Seoul, Korea, in the East Asia office of UNSCAP. But he has been a very fertile mind, if I could say that, and I have off and on seen his writings which are very deep sort of in terms of thinking and analysis. So I'm sure we are in for a very good discussion. So with that, let me invite Andrea to make his presentation. And then I will turn to the three other panelists. Andrea.
Thank you, Nagesh, and thanks a lot for the institutes actually for inviting me, and especially Nagesh and Yazi in Mumbai. Because I had to change for some reasons my plans, so I couldn't be there Tuesday as planned, and we managed to reorganize this, and very thankful for the very distinguished discussants for making themselves available also on Friday. And she raised expectations so high that I hope you will be disappointed. And without wanting to do that, we go into the presentation. If someone, next slide.
No, you can do it. Okay. You give the.
So this presentation is based on the economic outlook number 14 that goes back to the first, was 57 years ago, so about 57 years. We have introduced, thank you very much, twice a year economic outlook. In the time it's much more global, and not OECD countries, but increasingly non-OECD countries for obvious reasons, including in India. Especially, it was very nice to be in Delhi because they made a mistake at CII, and instead of calling me head of India Indonesia desk, they told me head of India Indonesia.
Hi, sorry to interrupt, but the voice is not very clear.
Oh, shall I get closer?
Yeah.
Would you? Yes.
Is this better?
Slightly better, yeah. So if you could come a little closer to the mic, yeah.
So thanks to the Institute in Mumbai and people for organizing this and being so excellent. So I want to the slides. We first focus on the first and second and third slides with the main messages. The main messages are, as Nagesh mentioned, that the inflation situation is making things much more difficult. And tight financial conditions which are to be imposed and introduced as a result of first inflation and pressure, and making the recovery of the resumption of growth at highest level much more difficult. And the countries that are being most where banks play a crucial and central role in financing households and populations, and those where housing markets are not very much share of lending or some assets almost. So this is true for many emerging economies, but also true for a number of countries in OECD, especially in Southern Europe. The other thing which is makes the situation particularly difficult to govern, so for people, analysts like us, to predict the future is that the relationship between inflation, economic activity, and labor market has definitely changed, and as a result of the
I'm sorry to interrupt, but those of us who have logged in, we can't see the slides changing, I think. If you're changing the slides from your side, it's not getting reflected on the screen.
No, yeah, he is still on.
Yeah, now it's fine.
She's like editorial is doing work. Is that what you see?
Can you confirm if you are seeing your?
Yeah, we can see the slides changing, but the audio is still not very clear, I'm afraid.
Okay. So strong. strongly expect this economy. Obviously, it's a positive signal with the markets which have become idle time with the not so positive consequence of the risk of persistence of inflation, and therefore of making monetary policy more difficult with the implications that this has for emerging economies. In the euro area, it's still from here, but the fears is that when this will happen, the point will be severely negative, and therefore that the income activity or maybe stronger than we expect. So stronger than expected in the US, stronger than expected in Europe. And emerging markets, including of course India, are in general very better than advanced economies, with some exceptions, one being Argentina. And otherwise, the situation is more positive. And as you will see, the contribution of the emerging economies, particularly Asian emerging economies, to global growth in coming years is going to increase. At the same time, emerging markets with structural level vulnerabilities, the market scrutiny. And this is something that is also.
Sorry for interrupting again. Sorry for the interruption again, but we can't really hear anything. It's difficult to follow.
Now,
I think there's some problem with the mic, I guess.
Yeah. Please, do you hear me?
Hello?
Yes.
Audio is not clear. Cannot hear.
So what is this? Is it better than this?
Rajeshwari, we can hear pretty well.
Yeah,
Well,
yeah, I think it's better than before. Maybe it's just a better idea now to just follow the slides, even if you're not able to understand the audio well.
Now
It's small anyway. Can't read it.
this
If you can't see the slides, we can send you these emails. I'm sending you. Is that accurate? So maybe director.
yeah, okay, if you can share the slides, we'll put it up here, but I don't think the slides right now are moving. We can't see the slides moving.
Maybe this might be better. Maybe you come.
is it better?
Bharti, I think the slides are still moving because he's currently on this slide, editorial restoring growth. But I think once the audio becomes clear, it will be better.
Okay, so I don't think, Professor Nagesh, there's any need to share the slides. We can look at the slides then.
Okay, good.
So basically, the three main messages on the slide are just revisions. So I don't know whether you heard them. One is that the relationship between inflation and activity labor markets has changed, and this makes it much more difficult to predict the future and as a result of conducting policy. The second issue is that in the OECD area, the US has been doing much better than expected, and while in the euro area things so far have been relatively common, there is a risk that when they increase in interest rates, they hit the economy, they will be stronger than expected. And the 2 points that emerging markets are generally feel better than advanced economies. They contribute an increasing share of global GDP, with India and Indonesia also in the lead on this. But at the same time, some emerging economies with structural vulnerabilities are present, are coming under market scrutiny, and this may have implications over the short run. In terms of also the global trade, see that the consistent weakness of global trade, which is due to both cyclical and structural factors, just to list them the geopolitical tensions following the invasion of Ukraine by Russia, the war in the Middle East is having an impact. Generally, the geopolitical considerations in global trade and the whole repositioning, reorganization of some global chains is also an important element which explains the weakness of global trade. And finally, again, this is just synthesis of slides I'm going to show you great is that there is definitely a need for improving the capacity in the base of the structural reports. This because of fiscal pressures which are mounting, especially in OECD countries, especially in OECD countries which are facing the demographic transition, which will increase the cost of the welfare state. But also, this is something that is becoming apparent also in some emerging economies in India, of still huge demographic dividend to exploit, including Asia, South Korea, Japan, and also China facing a demographic transition which will increase the fiscal pressures. So from now on, it's mostly graphics. The first thing is that we expect the global growth to remain modest. As you can see here, below the world normal average for the first 20 years of this century before the COVID epidemic. And this is true in particular for OECD countries, as you can see that very far from the but also this is also true for the non-OECD countries, with exceptions you will see for India, Indonesia, and this is China. Now, most of these things are all you know them highly hard. Is defined. The substantial share of growth is coming from emerging economies from emerging Asia, with India in particular, but also Southeast Asia, ASEAN countries contributing a lot to the dynamic Asian economies, contributing a lot. The contribution of China remains very sizable, because China's economy is much, much larger than the other Asian economies, even if in percentage terms growth is coming out. Latin America, emerging economies, is not contributing as much as it did only a few years ago, and this has to do with the problems in both Argentina and to a lesser extent Mexico and Brazil. Trade growth has slowed down. Now, there are two reasons looking at this, I guess, interpreting correctly. One is, of course, to see this as a proof of kind of deglobalization or very slow increase in globalization. The other is possibly that we have reached a level of globalization which is probably the most that can be accomplished given the current policies and given current developments. So that the kind of low-hanging fruits of globalization which were in the first century, especially following the WTO, China entry to the WTO, this has been completely exploited. So now we are coming to the more difficult part in terms of this, leaving aside the question, the fact that I was mentioned before, we are coming into a more difficult phase of increasing globalization, especially when we reach the sectors, the public utilities, the government services that traditionally are not available. So that's a different way of looking at this, which is possibly less dramatic than what is the same. And here you see that over the next few years, we project that the growth will actually slow even further in the case of services. Financial conditions have tightened substantially, in particular in the United States, but also in the Euro area and in emerging economies at a later stage. But this is not having yet the impact that one could expect that in Europe, also because European inflation all in all remains a bit lower than the United States and has come down with the latest reading in November, which I'm looking here. But the risk, of course, is that because of the bank sector and structure sector in Europe, especially in Southern Europe, monetary mechanism, it's that the implications will be particularly negative. Some high frequency indicators on economic activity give a mixed picture. Here you see, again, there's no point in entering and the description of each of them. The general point is that it's not particularly easy at this particular juncture to really understand what's happening when looking at the short-term high frequency indices and observations. And this way it's also true of his opinion, which your expertise is much more. Related facts, here data is coming from and the data has come up, it's increased. And so we are facing a situation where, again, we are always used to think about it on the one hand. On the one hand, high markets means risk of inflation. At the same time, people want to look and want to wage. So obviously that's also important factor. And in fact, that's numbers on distribution in a number of OECD countries suggest that labor is gaining some ground some distribution of it. So again, different ways of interpreting the same evidence on inflation is finally so the impact of increases the monetary tightening in first in the US and the Europe stuff the world. The impact is showing up. So is in the inflation, even if percent we so the impact on investment that generally on GDP growth that is slightly negative. So monetary policy seems to be doing its playing its role, even if differences while looking at inflation and core inflation is still a bit high. Inflation has come down, but just like it's a much faster reacting than so just like it's come down, it may turn up return to set. So it's fast. So these are and India projections were made some 3 weeks ago when it's expecting growth in the third and second quarter fiscal year to be much lower than expected. And government actually revised. I was not alone, but this is more consolation. So definitely, as you may have seen, that the RBI has revised this at the end of the monetary policy committee meeting this week. Just today, revised its GDP growth figures for the fiscal year 23-24 up to 7%, and many other institutions and many other. And many banks have also revised more HSBC and others have revised their numbers. This number starts rated for this of 23-24. And when looking more generally, and so I don't want to spend much time on it now, as you can see here, there's been a number of revisions made with respect to the main previous OECD this year. And with the exception, obviously, of the United States, where you can see there is a green arrow pointing outwards, which means that the revision has been out. And now the other country, which of course is central the worries and concerns and expectations of our observers is China, and we have maintained more or less our forecast for 2023, and revised it almost so this has to do with the situation of the housing market and the exposure of the housing. Inflation projections again, you see here with the bar is 2024 and the point is 2025. And I don't know, you can see there is a general expectation of inflation from the 24 levels going into 2025. And this implies also Argentina, which is not a major economy in any sense, but it's one of the mentioned because of the new inflation, which may turn into inflation. Expectation is that the inflation will come down in 5 years if it remains at very low. And Turkey is another country with that action, but still with some inflation. And given that Turkey is growing still faster with Argentina is moving at all, which is taking our tomorrow, which on Sunday, which we will see policies. China is the exception, so the projection will be seen defined slightly, but still in limits. The risks, the geopolitical tensions, and this will be outside of our realm expertise, and definitely outside of our capacity to influence the results. But what is important is in things, the Middle East is the largest share of the exports. So any part of the loosening of tensions, especially will be the possibility of closure of the major trade routes would have implications. And the other thing is the shift in the trade patterns. We can see here in terms of the sourcing. And interesting fact is that most countries have reduced their exposure to China in terms of percentage of their trade with China. Indonesia is an exception. It's a country that follows, so it's an exception. Second, really what is based on what will be the effects of monetary policy tightening on inflation. And here you see here the share of with inflation in the CPI plus the different countries, the share of inflation on at least 6% for at least a year. And you can see that in general there's been an increase, or looking at the countries, and some countries it maybe there's a small percentage, and Japan is almost zero. Still, Japan is probably the exception with some inflation, and not with zero negative inflation. Still, you see there that in the number items like goods and services and the CPI instead experiencing an increase at a rapid rate is increasing. So, and the third one is more on the positive side that savings that we did since the pandemic, especially in many OECD countries, they could boost the consumption. So if since household savings turns out to support that consumption that the countries take advantage. In terms of the policies, the message that comes out from our analysis is that the monetary policy stance is not yet time to loosen, to inflate. And this is something which I guess is shared by the RBI. Looking at the statement made at the end of DC today that suggests that there is not an increase, decrease in the policy rate, but also that the monetary policy stance remains effective, but there are relatively positive numbers from GDP and also from inflation. So, and in general, if you look now in the G20 countries, there are still some countries like some central banks, like Australia, or actually the Bank of Indonesia that have recently increased their policy rates. So there's still a lot of time for entrenchment, accelerating monetary policy. And we'll see that because that is going evident. And here you see that the difference from in terms of increase. This is the sustainability analysis made for 15, 17 years. And you see here that there is the change in balances the net is going to rise pretty fast in around countries, including countries like Italy or Japan. It's already very high. The government to so fiscal policy needs to prevent unsustainable debt public debt increases. And again, these are the mechanical projection of the net economic debt consumption of non-productive action you see here, Italy and Japan, but also the United States being on unsustainable path. Also because the need for fiscal policy to address the medium-term pressures that becoming important, especially because, as I was saying, the demographic situation is worrisome. For the constant aging will take an increasing share of companies, and that is, of course, worrisome because of the need to increase the productivity in order to ensure sustainable growth in the plan, and also the need to invest in not only in traditional education, traditional sectors, but also in new sectors like digitalization, like construction, digital construction, and it's important to the government's funds. And from that point of view, improving competition is crucial, and trade is also crucial, especially trade services. This is some numbers. And there is another which has come out over the 2 to 3 years, and that defense expenditure is on the rise in many countries. Now, of course, the defense spending is really legitimate in response to concerns about tensions. It's also money that is to be found somewhere. So if it's used, if it's the money that otherwise pensions purpose, some tranche be made. So here you see that in general, and especially for some countries, the defense spending is rising as a percentage of GDP. And I have what evidence. Yeah. 5 minutes.
Yeah.
Some simulations which have been made on the impact of an average rise in trade intensity on MLP show that on a 10-year interval there is a sizable the opposite sizable that makes reductions in trade and real ties in trade negotiations, especially because it would help in the green transition, not only because it would the potential for becoming but also because the more liberal regime don't use technology, transfer clean technologies would be easier to make and report the results of technological change and the results of creating investment in green technologies would spread through the economy and with borders. But that's another element to take into account. I added some considerations about India. Again, these are numbers and figures that you know. So GDP per capita is returning to the pre-pandemic growth trajectory. So obviously there's been a couple of years that we lost, but the real GDP that is growing again at the prevailing before the pandemic. There is some concern in looking at these numbers in a mechanical way, is that when other countries think of China, they also think of Korea, and even other countries when the GDP become the PPP terms, which was as distant from the frontier from the United States as India is today. India one has now 15% of GDP become the US. When China had the GDP terms, which was 15% of the US, it was growing 12%. When Korea, same Asia, was also raising and growing much faster than India is today. So on the one hand, these numbers are positive. At the same time, I think that they must be taken into look at in terms of other benchmarks against the other experiences, and they are not so impressive in a way I think. I mean, there's no complacency, I guess, in India these days, and there's satisfaction, but not complacency, but it's important not to fall in prey of complacency at 7%. It should be, could be much higher. Now, of course, the global economy has also changed from the days of the Korean miracle, Chinese miracle. Inflation remains above the midpoint of the target band, which explains the decisions of the RBI. Well, of course, I mean, again, this we know labor productivity is low, and that's the reason why the catch-up is not as rapid as desirable and considered as needed. And here you see some data from the APO on the level of GDP per worker in 2020 in India as compared to others. And of course, all these numbers are always subject to improvement, but the broader story is pretty clear here. And investment is low by Asian standards. Again, we heard that from the chief economic advisor at the conference with Nagesha, and that is the cause of concern. The situation is slowly improving, and as I said, again, you are the experts on this, and in terms of the corporations, the firms, there's a long tail of, so there is a growing number of firms that invest and are competitive that raise the number. I think the issue is not only to raise the investment rate of the global champions, is to raise the numbers of the regional champions, the national champions, the regional champions, and eventually the global champions. So in order to lift the boat for this project, and government investment is positive trajectory. I think that just to finish the impression of that daily now, 10 years ago when I was last year, the construction is certainly of a much higher quality and much more extensive, including the subway, and that's certainly something important. Public debt, and again, that's I think the main concern. The public debt is higher than in peers. So this is a comparison between India and the countries which have the same sovereign rating of India in orange, and as you can see here, India has a higher public debt. Now, public debt, of course, is not necessarily a bad thing. The return from an investment that is made with the public debt is sufficiently high, but it's certainly a cause of concern. And it's also true that the maturity profile has lengthened since 2018. It will be considerable. The weighted average maturity of the Indian debt has gone from 10.10 years and a half to almost 12. So that's something which has also to be reckoned. But if there is what we don't expect, but if there is a crisis in emerging economies and contagion effect, of course, that may have consequences. Now, the other thing is climate change. India is vulnerable to climate change to a larger extent than its peers. This is a comparison made with the other emerging economies. And you see here, this is a synthetic industry from Notre Dame University in the United States, where you see that actually the score below score mobility in this here is not really context shielded from climate change risk to them. The same time, again, these two modest improvements which have been made, and yes, you see that more than 40% of generation capacity in India is non-fossil fuel, which is a really impressive results in the next few decades. So we've been empowered so much and being playing in genetics. And with this, I conclude that we have some other slides on the way we identify the main structural reforms which are needed, but we have on this exercise for this up to be more time for the discussions and the discussion. Thank you again for your attention.
Thank you very much, Andrea, for giving to us a very comprehensive insight from this latest report of OECD. And I think, of course, your India numbers need to be updated, and everybody was caught off the line by the quarter two projection, which make all the projections of before that. Sorry, so the quarter two outdated. So it's, let's say, is the Indian economy did better than expected. So, but any issues which come out how India is treated vis-a-vis rest of the world and its peers in Asia, and in particular, the climate change world of the nature, and then peers is something very important for us to keep in mind, and also productivity, where we are more peers in require some attention. And where infrastructure, of course, is improving as you noted, lower than the peers. So a number of issues have come up from this presentation, which will need to be moved on by Indian policymakers. So with that, panelists, and the first one is Mr. D.K. Joshi, the chief economist with the most important rating agency of the country's CRISIL. I mean, may be familiar with the CRISIL, and okay. So he is very open in the media about listen to with rapt attention on his analysis of Indian. So over to you.
Thank you very much, Dr. Nagesh Kumar. I hope I'm audible, and thank you, Andrea, for giving such a comprehensive presentation. So, how much time do I have? I'll accordingly speak.
10 minutes. Is that fine?
Yeah. Okay. Yeah. Yeah, so I think our parent company is Standard & Poor's. So I think we take their global outlook as our global outlook. So I think the broad drift is similar. I mean, what Mr. Goldstein was saying and what I think our prognosis is. There has been a synchronized rise in policy rates across the world, but the outcomes have not been synchronized. Outcomes have been unsynchronized in some sense. And this is because I think there have been differing speeds of monetary transmission. Transmission has been faster in Europe and somewhat slower in US. Fiscal impulses across countries have varied quite a lot. External conditions and dependencies also vary. So that's why the outcomes are quite different. But there's a common thread that we see across the developed world, particularly. I think the labor market strong, which was mentioned. There is spending on services, which is still continuing. Fiscal tailwinds are there. Savings, I think, can be unleashed to support the economy. But I think there are core price pressures. I mean, the core inflation in advanced part of the world is above the headline inflation. In India, core is below the headline inflation. So, but that still doesn't provide comfort to the RBI, as we saw in today's policy. I think on the issue of soft landing, I think that's also a base case for us. But the monetary policy in general is at a very delicate juncture also, because it's very hard to assess whether you will over tighten or you will under tighten. I think so. They're struggling in that range. But I think the for emerging markets, particularly India, I think the higher for longer stance of the advanced countries puts some pressure on the banks in the region to be not able to ease, even if your inflation is under control. Let me give an example. The Indonesia recently raised rates and not because their inflation was unmanageable, but because of the capital inflow issue, I think, and the pressure on the currency. Similarly, Thailand is raising rates because I think they expect the growth to be stronger than and put pressure on inflation. So there are various nuances. But if I were to say one single sentence, what is happening is that the lower core inflation, which is not only in India but also in other parts of Asia, I think it allows it means that central banks will not raise rates for sure. But because of the higher for longer stance in advanced countries, they will not be able to cut the rates also very quickly. And I think that's similarly same situation is for India as well. I think we don't see rate cuts happening anytime soon. Maybe in the April to June quarter of next fiscal year is the earliest. The other thing is, which is really interesting, which came out of Mr. Goldstein's presentation also, is the emerging market and developed market, some kind of I won't call it decoupling. I mean, we are all integrated, but there is some disassociation that seems to be there. Because what I did for India a couple of years back was that we plotted the GDP growth of India and that of advanced countries. And we saw a very interesting conclusion come out of that. The growth cycles of India have become synchronized with the advanced countries, obviously because we are more connected, we are trading more. But the trend moves in different direction. I mean, trend in India is moving up because we have the opportunity to raise our potential and grow faster. That doesn't exist so much in the advanced countries, which are aging. So the long-term growth prospects are different. But what's happening right now is that even the cycle seems to be a little disassociated. I mean, India's cycle is much stronger than what and is expected to stay strong even next year. I think as if I go by RBI's projection or even by our own forecast. So there seems to be some disassociation even in the cycle. The Asian emerging markets, excluding China, they're all supposed to hold on to their growth, despite Europe being weak and despite US slowing down next year and China also slowing down. So there's something going on there, I think, which needs to be, it could be a transitory phenomena, but I think there's something going on which is making the cycle also not that interconnected with the US. Now, I think I think one final thing on the global, and then I'll say a few words on India. I think what is really interesting, what I've been observing from the forecasts of IMF or World Bank, and even the OECD report points out, the global growth is likely to slow in 2024, is projected to slow, but the trade is going to expand. Volume growth in trade is very high. I think the OECD is saying 2.7%. The IMF is saying 3.5% in 2024. WTO is saying 3.3%, which essentially means that the trade to GDP ratio is going to rise, which is now I think this probably could be a consequence of revival of goods now, because services will slow and goods trade will pick up. Demand will pick up, so merchandise trade might also pick up. But this is a very dramatic upward shift in trade in this very restrictive environment. So I'm a little skeptical on that front. I mean, how much we will, as an economy, can latch on to this if actually plays out. Because over the years, India's exports to Asia are falling in share. I think we had a share of about 33%. It is now 26%. In the 5 years, the share of exports to Asia have fallen, but our exports to US and Europe have risen. I mean, they were around 30%. They are now 33% in the just last 5 years. So clearly, I think there's a lot happening globally. Coming again back to India, I think I do see some upside to the OECD forecast, I think of 6.3%, because I think this forecast was probably made before the GDP data for the second quarter came, and RBI has also revised their growth up. So there is some likely upside to this. And the drivers of this growth have been largely the government, which is pushing investments, and also also government consumption, which is basically has gained momentum in the second quarter. And this is likely to continue, this being a poll-bound year. So the point is, government has had a very critical role in this growth recovery. Now, deficit, the debt, I think levels are high. I think they are higher compared to the other peer countries. So we need to bring them down. So the next year's fiscal policy will have to pull back on public investments that are currently taking place. And private sector has to take the baton from there. Conditions are right, but I think the uncertain environment makes it difficult for the private sector to unleash their full animal spirit, I mean, so to say. So the first half growth for this fiscal year is 7.7%. Second half is slowing down to 6.3%. And that's because of, I think, partly because of global slowdown, partly because the interest rate hikes are expected to slow domestic demand. And finally, the one thing that we didn't talk about much is the weather. I think the agriculture has done exceptionally well in India since the pandemic struck. I think this is the first year when agriculture is not expected to do that well. In the second quarter, agriculture growth has already fallen. Now we have the government's estimates saying that the summer crop will be about 4.6% lower than last year. For winter crop, I think the water reservoir level is low, and I think on top of that, the global El Nino is likely to persist into 2024. So I think agriculture is a risk for a mild risk from growth perspective, but a bigger risk from inflation perspective, because food inflation for most of the things are in double digits. So let me stop there. I might have spoken a little more than I should have, but I think thank you very much for your time.
Thank you, Mr. Joshi. I think that would be insightful. I'm sure there's giving those on your insights which you shared in depth. Let me now, I think, Swami Dua. Professor Swami Dua was actually very recently director of the School of Economics and continues as senior professor and both today higher education. So I'm sure she will be able to add some insights to this discussion. So over to Lua.
Thank you very much, Dr. Nagesh Kumar, and thank you, Andrea, for a wonderful presentation. The audio was not so clear, but I followed your slides and made a lot of sense out of those slides. So I just want to start by reiterating a couple of points that you had made, that global growth is set to remain modest, and that the OECD report projects that global GDP growth will be around 2.7% in 2024, with some improvement in 2025 up to 3%, and that Asia is expected to continue to account for the bulk of global growth in 2024 and 2025, and as it did also in 2023. And the other point that you had made was that the consumer price inflation is expected to continue to ease gradually and back towards what central banks have targeted in most economies by 2025. Now, if I apply these to India, so I'll talk about the Indian economy. Now, in terms of GDP growth, as you have shown that India is on the top amongst G20 economies, with a GDP projection in the year 2024 and 2025 of 6.1% and 6.5%. Of course, we can debate about these numbers, but I think let's just look at the directions. So there's an upward trend, as we can see. And what we can say about the Indian economy is that domestic demand is currently sustaining economic activity, and the growth is mainly driven by public investment, and also there is now increase in private consumption. However, there is some decline in merchandise trade, but services exports are strong, and also India is doing well in terms of the FDI and FII flows. Now, inflation in India, that is projected to decline progressively, and this is for various reasons. Better weather conditions, there have been productivity gains from recent policy reforms, and also global conditions are expected to improve. And all of these are expected to bolster growth and also have a mitigating effect on inflation. So, for the Indian economy, the key point is that the economy remains resilient despite the pandemic and the geopolitical conflicts, with the strong domestic demand. And then, coupled with this, we have financial inclusion, digitalization, global competitiveness, green transition, and also increase in productivity. So, for the Indian economy, I would like to highlight first the financial inclusion and digitalization and how this is fostering economic growth, and in fact, how this has become a model for the world to adopt. And in fact, financial inclusion is one of the primary goals of the government, and that is to put people under the ambit of formal financial institutions and provide access to credits, insurance, microfinance, and other banking services. So, as we know, India's financial landscape witnessed a massive change in recent years. The implementation of the country's digital public infrastructure, which includes the digital ID system Aadhaar, United Payments Interface, and DigiLocker, which is the digital document wallet, has transformed the financial inclusion landscape in India. And the availability and spread of digital infrastructure has contributed significantly to economic growth. So, this is a very important point in India. And the emergence of the digital public infrastructure aimed at improving financial literacy, innovation, entrepreneurship, employment generation, and empowering beneficiaries. And by this process, uplifting the economy, for which we see the results. And the growth drivers of the digital public infrastructure have been the favorable demographics and also the expansion of the middle class and also the mindset towards digital behavior. So, all of these have helped to make India a competitive digital economy, and also that has helped to bolster economic growth. So, this is one point. The other point, which is somewhat a concern and which you have also mentioned, is about climate change and green growth and clean energy. And these are concerns that we have. In general, if we look at emerging economies, these are particularly vulnerable to the effects of climate change because they are already facing a range of development challenges. For instance, poverty, food insecurity, and limited access to clean water, sanitation. And on top of this, if we have climate change, this only aggravates these challenges and it poses additional risks to the livelihoods and well-being of people in all of these countries. And India faces all of these risks, and it is a number of measures are required to combat climate change because this will pull back the economy. And one therefore has to think of in trade in environmental goods and services, nurturing green businesses, developing carbon pricing mechanisms, and also one that can be done by India within Asia is strengthening regional cooperation through trade agreements, trade and investment agreements. So more emphasis can be placed on that. And other steps that India can do to combat climate change and to stop it from being a deterrent to economic growth is that it can reduce the emissions embedded in their trade by moving up the global value chain. Now, We have to see how much that is possible, and also diversification in exports. So these are steps that can be thought about, considered to meet this challenge. Now, the government is very conscious of this issue, and also the issue of clean energy and green growth. And this is evident from the huge outlays that have been made for energy security, energy transition, and also achieving India's goal of net zero carbon emission by 2070. Now, a major initiative that India took in this direction was the implementation of lifestyle for environment, which was discussed extensively in the G20 meetings, and which was also appreciated by the G20 member nations. And it has been decided to continue with this concept of lifestyle for environment. So this is a major achievement and contribution of India, not just to India, but also to the world, that this can help us solve the problems of energy transition and clean energy transition and green growth. And of course,
Windows collect.
2047. So,
No. No, sorry about. I was just asking them. Yeah, we go. We go.
is it okay now? Can you hear me?
Yeah.
Yeah. Okay.
Yeah, we can.
All right. Okay. So, because of all these initiatives, so India is also becoming a favored destination for renewables, but a lot requires to be done in this area. Now, if you think of other steps, for instance, if we look at the recent report of Standard & Poor's Global Ratings that was released on 5th December. So that talks about India becoming the third largest economy in the world by 2030. So, how is it going to do that? The report also says that the GDP growth is expected to be around 7% in 2026-27. Now, here the points that the report notes is that this depends on the labor market potential. So we have to target the labor market potential, which would require looking into upskilling workers and also increasing female participation in the labor force. And therefore, this will allow us to exploit fully the demographic dividend that India enjoys. So one point is then also of the demographic dividend. Then another point that you had shown in the graph was that the productivity of India is lower than the other countries that you had on that chart. So that is true, but if you look at the trend of productivity, whether you look at labor productivity in India or total factor productivity, you will see that it is going up now. So since 21, 22, it's on an upward trend. So if you see it by itself, you will notice the upward trend. So I think that is a positive. And then what else we can say is that what is the policy space that we have? If we want growth to increase, even if we say that India has been more or less resilient to these risks, but how do we tackle economic growth? So the policy space, I think, maybe more fiscal efforts are required. You need, of course, fiscal consolidation, but you would also need some fiscal steps that would help to mitigate climate change, that would help to eradicate poverty, and also help to reduce inequality. So some efforts are required in terms of the fiscal policy. Now, monetary policy, how much policy space we have, that depends on whether we can have monetary policy easing or not right now. And that inflation continues to be a risk, and if the situation is uncertain regarding inflation, and therefore we cannot say much right now about monetary policy, but fiscal consolidation, public investment, these are things that we can talk about. And one more thing to conclude my talk is that Dr. Joshi talked about synchronization of the world economies, and that is true that we saw during the pandemic also. We saw the synchronization in terms of the interest rates, and we see it after the pandemic also. If you plot all the countries together or divide them into different groups, you will see that synchronization. And you will see more or less the same synchronization if you plot GDP or inflation. So I don't see some decoupling or anything. I see it more or less synchronized. Some lead lag may be there, but it seems to be moving in tandem, although each country has its own structure and its different policies are required for each country. But if you look at the fundamentals in terms of inflation, GDP, interest rates, they are all more or less in tandem. And with that, I think I have exhausted my 10 minutes, so I will stop here. Thank you.
Thank you. I think again, there was a set of very interesting insights. But yes, I'm sure that's listening to the great attention. Let me now heard that this issue we said was that 0. And issue is that the associate professor and issue. So she will also be sites for that. Over to you.
Thank you so much. I hope I'm audible. So I have a slideshow. I'll just quickly share my screen. So thank you so much for inviting me to discuss the OECD report, and thanks, Andre, for your to hear properly. But I have gone through the report and I was able to follow the slides, so that helped. The disadvantage of being the last speaker is that almost everything that could be said has already been said. That too by experts like Mr. Joshi and Professor Du, of course. But so what I'll do is I'll focus entirely on the outlook for the Indian economy aspect. So roughly, I'm going to talk about the current economic situation, the future outlook, and then end with the concerns and opportunities the way I see them. So this is the slide that Andrea also presented, where we essentially see that as far as the GDP growth rate is concerned, India undoubtedly stands out compared to all the countries in the world, all the major countries in the world, not only in the developed world, but also in the emerging world. So the OECD report forecast was 23-24, the GDP growth rate was going to be 6.3%. Maybe it'll get revised upwards. But even then, it's basically stands out compared to all the other growth rates of the developed as well as emerging countries, which means by the real GDP growth standard, we're definitely doing better than all large economies. When it comes to, the one thing that I want to point out is, perhaps when we look at the aggregate GDP growth picture, it hides a little bit of an underlying reality, which is what I want to highlight. One is that we saw that the post-pandemic recovery period witnessed sort of a K-shaped economic performance where the economy became like a two-speed economy where some sectors were doing significantly better than the others. And we do continue to see anecdotal evidence and data from high-frequency indicators that K-shaped consumption pattern continues. So, for example, we know that in the mass market demand, for example, from the FMCG sector or the two-wheelers, excluding the festival surge, is significantly weaker than demand, for example, the premium discretionary products like SUVs and luxury goods. We've also seen from the latest GDP data that there has been a significant growth slowdown in agriculture in the rural areas, also slowdown in trade, hotels, transport, communication, much of which is actually largely informal. That also points towards the K-shaped recovery, or let's just call it a K-shaped performance right now, since we are way past the recovery. So I think that's something that would be a little bit of a concern as we go forward. There is also evidence that consumption growth is slowing down, and potentially this also points towards a weakening of the post-pandemic reopening momentum, which helped us a lot last year. Much of that momentum could essentially be weakening right now. And the other point I want to mention in this context is that the OECD report mentions, and Andrea showed a graph as well, that in India, the real per capita GDP growth, or GDP in general, is returning to the pre-pandemic growth trajectory. But we also have to remember that pre-pandemic, the Indian economy was actually in a precarious condition, and the real GDP growth rate was less than 4%. So while we may be going back to the pre-pandemic trajectory, it's still not really a very robust performance, so to speak. On inflation, this is again a chart taken from the OECD report. One thing to see is that if you see, India is essentially the second vertical graph next to Russia. And it means that while inflation in India has still been slowing down, it continues to be higher than most countries. And that is definitely something to be a bit concerned about. And the Reserve Bank of India continues to flag inflationary concerns in the monetary policy meetings. So that probably will continue to be a little bit of a worry. On the other hand, when we see the core inflation, there was a period when core inflation was persistently increasing more than 6%, but of late, for the last few months, core inflation has actually been declining and it's going close to 4%. Now, the question is this a sign of monetary policy transmission, or is this a sign of slowing aggregate demand? Because as we know, core inflation is the structural inflation. And is core inflation declining because aggregate demand is slowing down? So that's something that I think merits some thought. Now, focusing on the future scenario, I would say that, yes, the global outlook is probably going to weaken going forward, but it could impact India a little bit differently, because India, unlike, say, countries like China, is not a major goods exporter. And we did see that even when last year the global economy was slowing down, the boom in service sector exports, in fact, helped to improve our balance of payments significantly. So I would say for India, more than the overarching slowdown of the global growth, what matters disproportionately is what is the outlook on the global services sector, particularly in the global IT and related sector, because I think that affects us much more than slowdown in the global merchandise trade. And also the other side of it is, if there is indeed a global slowdown, which lowers, for example, commodity prices and oil prices, that ends up improving India's terms of trade because we are a net importer of commodities and oil. So if there is a combination that the demand for India's services exports continues and the cost of imports continues to be low because of low oil and commodity prices, because of a global growth slowdown, it might end up improving our external balance. So I think the way we see the impact of global growth on India probably needs to be a little bit more nuanced. And it can even be a situation if the US is slowing down, with the bond yields coming down, there might be a resurgence of capital inflows into India. So there are multiple aspects through which global slowdown may affect us, and not all of them need not be negative. I would say that the concern for the future in macro scenario in India is more local than global. And this was mentioned both by Mr. Joshi as well as by Andrea, that I think the fiscal scenario is something that is of a serious worry in India, because the last budget speech mentioned that the government is planning a reduction of fiscal deficit from 5.9% in 23-24 to less than 4.5% by 25-26. But we haven't really seen a credible medium-term fiscal consolidation framework. So the question is, will there be a rise in taxes, rationalization of spending, a broadening of tax base? So unless we see that happening, I think the fiscal situation continues to be a concern. And of course, as the government continues to borrow more, that also crowds out the private sector. So the one way to do the fiscal consolidation, other than raising tax, which is not a possibility right now, or cutting spending, is higher than potential growth. And if we look at the growth drivers, till now, government expenditure and consumption were the main drivers of growth, and to some extent service exports. But now government expenditure is going to get significantly more constrained because of fiscal consolidation requirements. And we know from the latest data that consumption is slowing down. And private investment still hasn't picked up in a strong and sustained manner as was expected. And we also know that manufacturing exports have been contracting. So increasingly, if consumption starts slowing down and government is not able to provide further capital expenditure impetus, then the drivers of growth is something that I think we need to watch out for as we move forward. Inflation, the OECD report states that RBI may start lowering rates from the middle of next year. I think exactly as Mr. Joshi mentioned, that a lot might depend upon what the Fed does, because if the Fed continues to hold rates high for a longer period, there are clear exchange rate concerns for India. And whether the RBI will ignore that and will only focus on domestic outlook, that is also something that's worth noting. And also, I think there is a bit of a dichotomy that if the economy will continue to grow rapidly, then inflationary pressures will continue. And there are also uncertain monsoon and food supply shocks, etc. So I think the inflationary scenario will continue to be a little bit more uncertain than what we think. Quickly on concerns, as I said, fiscal consolidation, I think, is a serious concern for the domestic economy. One thing I want to flag is there are many experts have pointed out over the years that there are concerns with measurement in the official data as well. So therefore, to what extent we are formulating policy based on data that is kind of outdated because our base year revisions have not happened in more than 10 years. The weights of CPI and WPI baskets have also not been updated. So all of that, I think, will play a very important role as to policy being dependent on data that is not necessarily updated. Professor Dua mentioned that a concern, of course, is labor force participation rate. I didn't see that much in the OECD report. Particularly declining female labor force participation rate is something that would have been great to see a discussion of. And here, the service sector is becoming a very important part of our GVA, but that's not necessarily a job-creating sector. Manufacturing is the job-creating sector, and we could benefit from the China Plus One strategy. But we have seen the data that FDI to India has actually been declining, which is sort of contrary to what we would expect, considering MNCs are following a China Plus One strategy. So is it the case that India is not benefiting much from that strategy? I'm going to finish very quickly with this. I think a big concern, again, I didn't find that in the OECD report, but maybe Andrea can tell us later, is in the financial sector, the net financial savings of households is declining. And that obviously has repercussions for investment, etc. More importantly, much of the consumption demand that we saw in the last year was fueled by a surge in consumer loans. And RBI has flagged this concern multiple times. Unsecured consumer credit grew by 30% last year. And this is predominantly credit cards and personal loans, which means households are actually borrowing to consume, which is not necessarily a good sign. And that also means that there are financial stability concerns potentially building up in the banking sector, because 13 to 14% of the bank credit is in unsecured consumer loans. And the situation might worsen further if growth slows down as the higher monetary policy interest rates kick in. And if the banks start pushing brakes on consumer lending, then consumer demand may slow down even more. So that brings back with the growth driver discussion that if investment is not picking up and government expenditure is constrained by fiscal, then if consumption demand also slows down because of these concerns. So last slide is, I think it's worth thinking about the fact that we are sort of, as an emerging economy, we're sort of living in a new paradigm where the era of low interest rates and low inflation is probably gone. So the question is, how do emerging markets like India adapt to the world where the developed country interest rates are higher than what they used to be? So for example, when US interest rates was 1% and India could have 5%, we still had a 4% differential, which worked for us. But now if the US interest rate is going to be 3%, then where does that take our interest rates? And I think that's something that most EMs will struggle with. Also, the fact that we're living in a world where there is a growing trend of protectionism, with India looking inward, is probably going to put a drag on the momentum for growth. And lastly, I would say that two game-changing factors, one Andrea, of course, mentioned, is climate change And our climate green transition will be significantly a function of how much fiscal space the government has. And as I was just saying, the fiscal space may be much more limited than what we think. But to end on a bit of a positive note, I think artificial intelligence is definitely a very important game-changing factor for the next few years. And given India has a comparative advantage in technology and science and engineering, etc., we may play a very critical role in being at the frontier of development of algorithms, which end up making us use artificial intelligence as a very important instrument for improving productivity. And that's something that we should probably focus on a lot more. So I'm going to end with that. So thank you so much for giving me the opportunity. Thank you.
Thank you very much. In particular for your point about the K-shaped recovery or K-shaped consumption, the items of discretionary consumption demand is rising very fast, but the basic needs not doing so well. And this is also in a way a reflection of the rising inequalities in the Indian economy. Incomes getting locked with a very small proportion of the population. So some very serious for longer term demand and growth implications. With that, let me open up for discussion. So who wants to, can we see the show of hands? Who wants to raise in-house here and in ISID-IGIDR? Are there any friends wanting to pose any questions to any of the speakers? Andrea and any of the speakers? Yes, I see one from my side. Go ahead.
So, first of all, a very wonderful presentation and also the comments on the presentation. I would say that 2 points and 2 questions basically. When you showed the trends in the OECD countries, particularly advanced economies, and comparing it with India, this point has come with this discussion also that if you see the growth of private investment, that has not picked up in case of India, which has happened in case of the figures you showed in case of USA and France. So why it is happening in case of advanced economies, but why it is not happening in case of India, even if the government's capex has increased, but the private investment has not. Now, this may be related to what Dr. Rajeshwari was talking about, that there can be a decline in the growth of consumption, so the market is not so exciting for future expectation of profits, and that's maybe the reason that private corporate investment is not taking. The other thing which is striking is that in case of advanced economies, you see that a growth after the pandemic, when it is recovering, there is a tightening of the labor market. While in case of India, when we have a very high growth and also expect a very high growth in the future, as it is being shown, but now we have state which is highest in the past few decades. It's about 7.5%. And Professor Pamit was talking about that we use the advantage of demographic dividend. We are going through this phase when the youth unemployment rate is one of the highest. So how to address that problem? And if you are not able to address that, then of course the kind of projections we are talking about will not take place.
Thank you, Satyajit. Anyone from ISID-IGIDR? Hello? Anyone from ISID-IGIDR? Yeah. I see some movement. Can you raise your hand, please? No, I don't think there is anyone from ISID-IGIDR. Okay. Or anyone going online? I see some chat box to comments. Can you open them? Chair is showing two. No, not problem. All right. So in that case, let me turn to Andrea to respond to the question which was raised in the open discussion, but also made by our very eminent panelists. Anyone you want to pick up or just share?
Thank you very much. And actually, the very eminent discussants made a very eminent comments, which I really liked. So let me go through some of them. I think I may not have the answer to all of them, but I will try now in order, not necessarily in logical order, but in terms of now, one point is that of permanent consumption in driving growth in the recent past. And that's why I think that one of the reasons why we may expect a slowdown in 2024, 2025 has to do with the slowing down of consumption of the direction. So it's true that there are factors that I mentioned, including the lower exposure to trade of the Indian economy as compared to, for instance, China, very in the other direction, but that slowdown of consumption may be the main reason for the slowdown of the economy next year, next fiscal year. Now, another point there is to do with the mentioning of the strength of India as a large exporter of services. That is certainly true, and the impact of artificial intelligence, better competitiveness, and better comparative advantage of India is not so evident with this discussion with the regional government today, which was speculative but still very interesting. So its argument was that you may not benefit after all so much from the widespread migration as a whole itself, because many of the things that can be made right now in India, thanks to technologies that have that integration, that may become actually much more easier to do with the artificial intelligence, so that we to adopt some of the Indian elements of Indian practices. Now, second point, actually, very interesting issues we didn't discuss is the global competence centers, and that which is offshoring 4.0 in a way. And there, I think that it's interesting. It would be interesting if ever participated in PISA, so I think we are quite then things that can be made by moving to India. Unfortunately, India has not done PISA, as you know, was released 2 days ago. Actually, on the day of the release, the ISID-IGIDR please dispatch that by the OECD, by the way. And they would be, I guess, investigating important for India to participate there to have a better appreciation of that, which I mean is important to understand what that other policy drivers that they should be put in years ahead in order to maintain or increase the competitiveness of India in service exports in the AD development, artificial intelligence. And investment, why is it remains low in OECD countries as well? Well, I guess it has to do with the trend to long-term and possibly historical reduction in the rate of return on investment, which is, if I understood your question correctly, which is the main reason why we see also a lot of investment in speculative in nature, much more than in the past, and that's has to do with people like William Martin's very excited and work on this financialization of the economy. Now this is impeding making it political productive investment. So obviously in the short run, it's very difficult to beat the return on stock exchange with productive investment. On the labor markets, why I think that the important point was made by President Gupta about the reduction in the female labor participation rate, which is a cause of concern. Actually, asked yesterday the number of Minister of Finance and what that the government is doing, and she gave a number of and also included the number of policy measures which have been taken in terms of increasing government spending on education, which is particularly education for women, and also improving the tax system and not produce it more female participation and of obviously this is has to do also with cultural in a way as the economists tend to don't the importance of cultural features, but that measure model of countries being culture. I mean, I have a weekend which is a country which is facing similar issues of low labor, female labor participation, and so the cultural factor is important. And a very important point being made by President Gupta, which because the government made by short audio about this recovery, which is much more pronounced for luxury goods or goods that are consumed by the high income parts of the population, which is even in rural areas, but more generally, the demand for the bottom of the pyramid is not as brisk. And and I had here. But I think there is also obviously an issue in terms of in terms of the labor market, there is also an issue of the data, which is related to the importance of personal sector. We haven't mentioned, but obviously in India, like in China, any other emerging economies, remains an important part of the economy, which by definition is not covered by formal rules. So the analysis of the labor market performance has to be include that consideration. And that statement, I covered all the points.
You have. So with that, I think we have also, finished the time for this discussion, and unless somebody wanting to raise the comment or questions now, I'd like to thank everyone. And I see Kamal Malhotra. Kamal, you like to raise a point? No. You are muted. You are muted, Kamal. Yeah, now.
Yeah, am I unmuted now? Some of it was not clear. I wasn't able to hear some of it clearly, but I guess I wanted to raise the issue that can you hear me?
Yeah, in parts.
Can you hear me?
Yeah, we can hear you, but not very clear.
Yeah, I guess I wanted to raise the issue of the distribution of the GDP. I think only one speaker, Dr. Rajeshwari, touched upon it. And yes. I think that this is a really big issue in the Indian context, the K-shaped recovery or the K-shaped consumption. And I think it would be good if there was more discussion about that, because you can have macro numbers, but I think particularly in a context like India, I think there was reference made to the declining labor participation rate of women in particular, but overall low labor participation rate, very high levels of inequality, all of those kinds of things take away from this macro number, which is talked about. And, I would have hoped that some of the other speakers would have touched upon that somewhat.
Yeah.
Thank you.
Thank you. Yes, no, I think that's certainly an important trend we need to pay attention to. How the demand for the products of them of the rich are growing very fast. Luxury cars, for instance, and those of the items of mass consumption not doing so well. So this is something pointing to very big concern. So regarding anybody, we need to pay attention to that. So that's very well taken. So with that, I think I just want to thank everyone because this was very rich discussion. I don't really want to summarize that. I think what comes out of the presentation of so the benefits. And then Kogi is certainly poised to grow in a and do that. Yes. But yeah, in global policy forum, there they were very much finance minister to give. But we also had the trajectory of India's economic years or so. There is no high degree of dynamism in terms of growth, but also greater degree of inclusiveness, so that job creation is looked at carefully. We have the ability to job in decent jobs through factoring black and supporting, advocating for constantly that we pay attention to manufacturing, that the job situation in services for all their, very beneficial effects in terms of they can absorb only a small, highly educated, skilled people. And for that, we need to check. So, exactly in this policy forum, Robert Parliament also, despite the slowdown and India's large market, which you sort of asset, we can to build our capacity without voting for so on the situation at this moment from India is very, very optimistic. And focus on which is putting this is what to bring incentives and other policies. We will give growth which is much more inclusive through creation of decent jobs in future and the kind of patterns that are recovery or K-shaped recovery will be addressed. So that us the article and giving us a very comprehensive presentation, very insightful presentation. And three very distinguished points. Ms. Joshi, Professor Pakua, Sekunda, and all the ISID-IGIDR, all this conversation. Thank you.